Well, hello. Welcome, welcome. You're in the right place at the right time, guys. This is, of course, the first of our sessions, and we're going to talk about trading strategies today. So hopefully you can hear me okay. Everything's sounding okay. And if you have any questions, you can go ahead and pipe them through in the Q&A. Q&A is the best place to go because I will I'll miss it in the chat box. It'll just be too much going on there. Okay, so let's talk about what our plans are for today. Today we're going to talk about building a trading strategy, and the first thing I want to give you is a little quiz here. So what we're going to do here, we're just going to put a template on here so you can see this. My question for you, actually probably the best place to put this is over here. I don't want you to see what's going to happen. I want to give you the answers to the test. All right. So we'll do this. Question number 1. When you see this chart, what are you thinking? Hold on, I didn't do this very well. I'm gonna do it like this. I want to give you a good one. Okay, here we go. All right, when you see this chart right here, your thoughts are what? Your first instinct when you see a chart like this is that you would be looking for a sell trade, a buy trade, or no trade. All right? What would you be thinking if you saw that chart right there? Now we're going to do another one. So just keep in mind what your answer would be for that one. And now we're going to do this one, this next one. And in this case, we've got this one right here. Okay, here we go. Now on this one, we're asking you, when you see this chart, is your thinking that you wanna buy, you wanna sell, or no trade? What would you be looking for on this chart right here? And I'm going to give you one more. All right. Next chart, it's right here. And this one. So for this one, the question is, when you see this chart right here, what is your thinking that you want to, buy, sell, or no trade? All right. Cool. Excelente, my friends. Excelente. All right, cool. Now, what we're going to do is in today's session, we're going to talk about how building a strategy should be based not on the best trading system you can find out there in the dark corners of the interwebs, or the one that has the best tracker record, or the one that has the best back test, or the one that's been used by the most trading champions, or the trader with the best computer screen setup, or the highest win rate, or the highest reward risk ratio, or whatever. Really, I can say that the best trading system for you is likely to be different to the best trading system for me or someone else who's watching this right now. The reason we know that is because I've surveyed a lot of traders around the world. I've got thousands of, I think at this stage, I've got like 30 or 40,000, probably close to 45,000 responses from traders around the world. And one of the things I was trying to get at was, what do traders look for in the markets? Like, what kind of trades are they looking for? And by and large, about 80 to 85% of them are looking for what we would say would be like swing trades, reversal trades. And then 15% or so are looking for trend trades. So in the examples that I shared with you, the first chart was the chart going up. And if you looked at that chart and you thought that you would be looking for a sell trade, then you're a swing trader. If you're looking for a buy trade, then you might be a trend follower. And on the second one where the chart was going down, if you decided that you thought that maybe, it'd be best if you decided to take a buy trade there, then you're a swing trader. And if you decide that you'd want to sell there, then you are a trend follower. And then finally, that last chart that I just showed you, the one that had the range-bound market, if you were looking for a buy or a sell in that situation, or you're anticipating a potential buy or sell, then you may be more comfortable in range-bound markets. So you're not necessarily a trend follower. Now, if you were looking for like a breakout, you're going to say, well, if it gets up to this high and breaks out further, then I would buy. If it goes down to this low down there and breaks out further, I'd go short. Then maybe you're a breakout trader. But if you're going to trade within that range, then you'd be like a swing trader inside ranges, which is a really cool way to trade too. A lot of people forget about that. So the reason that's why I'm pointing this out is that there isn't really any one perfect way to trade. The key though is that you have one, strategies that fit your beliefs, and two, that you have multiple strategies, which is why in our next session, which by the way, our next session is going to be at not very long from now, actually in about 12 hours. So our next session will be in about 12 hours. So wherever you are in the world right now, if you're watching this, the next one, part 2, is going to be in 12 hours. So today, we have a couple of things we want to cover. And the first we've done, which is identifying, what you're comfortable with. You may notice, for example, that some of you are trend followers and you like to trade upward-looking trends, like maybe like this pound yen chart right now, which we drew this green zone in here earlier today during the webinar that we did for our members, and this bounce here that we anticipated was a sign that maybe, if it breaks this channel or bounces off this green zone right here, there was a sign that maybe it was going to go up. We kind of had a clue that it was probably going to be headed that way anyway, because we follow the open position ratios, and we'll talk more about those in the next session. But the open position ratios are a good tool to help diagnose where is the market headed. So that first thing that we wanted to cover here is that you need to trade the best strategy for you. The reason why we don't trade the strategy with the best back tests, or the strategy with the coolest guru behind it, or the strategy that trades the most trades or has the highest win rate or the highest reward risk ratio, is because that's not going to help you when you're in a drawdown. This is really important. Traders quit when they're in a drawdown. Okay, traders quit when in a drawdown. That's when they quit. And so if you understand this, then you have to once you understand this, it becomes so clear that the strategy that you trade, you must have rock solid confidence in it. And you must understand that it is a good way to view the markets. If you don't believe that your trading strategy is a good way to view the markets, you will give up and you will throw it away when it hits a drawdown. If you've ever been through the cycle of doom, like I talked about in my book in Naked Forex, then you understand what I'm talking about. Because I've been in the cycle of doom. I know exactly what it feels like. And so when you're in that cycle of doom, cycling through many different strategies, that's the point where you're basically saying, I don't believe in this anymore. And it isn't necessarily the drawdown that gets you to that point. There are a lot of different reasons why we get to drawdowns, and we'll talk more about those, especially in sessions 3 and 4. But the key point here is that if you trade some system that doesn't match up with your beliefs about what the market is and where the best opportunities are in the market, then you will not be able to hold on to that strategy when your confidence is low, which is when you're losing money. Okay, so that's the key point here, and I want to make sure that we're all clear on that. All right, so traders quit when we're in a drawdown. Oh, by the way, some of you may notice that there is a. I'll put it in the chat so everyone can see it. There is a link if you would like to. The stuff that we're talking about here, I just did the wrong thing. Hold on. I put the wrong one in there. So the link down below, if you would like to, if this sort of stuff that we're talking about here makes sense to you and you enjoy it and you think that it helps your trading, you may want to book a trading blueprint call. And the trading blueprint call would be with me or my trader buddy Edward, and we can talk about your trading, and we'll tell you what we would do if we were you, and if it makes sense, we may offer you a place in our one-on-one coaching program. We don't have a lot of slots. We're kind of in a pretty good position where we don't have to offer a lot of positions. We usually have about 2 a month come up. So and not everyone is a good fit. In fact, most people, about 2 out of 10 people, we may offer a slot. So it's not for everyone. But if that's something that interests you, you can click on that link and book your call, and we'll ask you a few questions about your trading and where you're at, and then we can talk. Okay, so that's for people who want to go further down this path, but you don't have to do that. That's not necessary. It's just for those people who are interested in that. All right, so traders quit when they're in a drawdown. So what we want to do now is we want to talk about, how do we build confidence in our trading system? Does anybody know that? Anyone? Let me know, what is the number one tool that you can use to build confidence in your trading system? What can you do? Eric? You can put it in the or Sean, you can put it in the Q&A. Put it in the Q&A, yeah? I didn't know this was live. It's live, yeah. Put it in the Q&A. Well, how do you build confidence, Eric? Backtesting, says John. Sean says, I didn't know this was live. Anonymous says backtest and forward test. Brian says use testing software. Anonymous says backtest. Yeah. So basically what you're saying is correct, and I would agree with that. And in fact, people will often ask me what is the best thing I can do for my trading. And if you lined up 10 traders along the wall and you said, Walter, which one do you think is going to be the trader that makes it? I would ask one question. That question would be, how much time do you spend in your trading simulator testing your strategies? And based on the answers to that question, I could tell you with pretty high confidence which trader is going to make it. One of my traders who just signed up a month ago or whatever in the one-on-one coaching program, he told me when we were talking about his trading in his trading blueprint call, he talked about how he was doing his back testing and how he did his work and all that. And I was quite impressed, and he ended up joining the program. But what was interesting is, as soon as he joined the program and he gave us his data, we looked at it, and we looked at a bunch of metrics, and he said, he said, I see now. I haven't been looking at my data in as a detailed point, as detailed as I should have, and I've missed a lot of these things. And so it also, what that means is essentially it's not enough to just do your back testing. You also have to learn your lessons from your back testing. So the answer is, as everyone has said here, all of you guys obviously are pretty clued in and know what's going on, but the best way to build confidence is to take a lot of trades. Obviously, you can take a lot of trades in a simulator, or you can take a lot of trades in the live markets. I know which one I want to do because I don't want, well, I've done the live markets, and it's very expensive. It's like going to an Ivy League school, right? You do get your lessons in the markets. It just costs more and takes longer. If you take a lot of trades in a simulator, you can do it fast. You can accelerate your learning curve and take, months and weeks instead of years and decades. However, it can be boring for some people. It can be boring to go back and continually work over your system and tweak one little thing and go through and do all your back test over again. It's an iterative process, and it's not that fun. Some people will argue that you should use an automated back test. And the only time I think that makes sense is if you're actually going to use the system, the automated system, to take the trades. If that's the case, then that makes sense. But if you're going to be the decision maker, then you should be probably taking the trades as well in the simulator. That's my point of view. So if you want to build your confidence, the best way to do it is to take a lot of trades either in the live markets, which can be expensive, or in a simulator. Obviously, in a simulator, I can trade the pound yen here 8-hour chart from 2002 all the way to 2022, and I can get a whole bunch of data on the 8-hour chart and see what my strategy would look like. And then based on that, I might want to also tweak it and adjust it, and then maybe I'll test it from 2022 to 2024 and see, again, these last 2 years, did it make money based on all of my 20 years of back testing. So that's how you build confidence. Absolutely. The way you build confidence is by taking a lot of trades. It's your choice whether you take them in the live markets, which is slow and expensive, or in a simulator, which is cheaper. Now, for those people who don't know, one of our members in the forum has a software called Naked Markets. It's naked-markets.com. It's Denis in France, and he's a great guy, and this is excellent software. So I would check that out. The other option, of course, is Forex Tester. I think that Dennis's is actually better than Forex Tester, but Forex Tester, you can go to fxjake.com/tester. There is a discount there if you use my link, and they will pay me if you use my link. But if you feel weird about that, you can just go to forextester.com. But Dennis's software is quite good as well. Very good, in fact. And in some ways, it's better, and it makes things easier, actually, than Forex Tester, which I never thought I would say. But anyway, so those are your options there. All right, so now the next thing I want to talk about here is, let's see, what do we got here? Yeah, so we talked about, traders quit when they're in a drawdown. That's when we quit. And the way that we know that we should trade a system is when we have back tested it, our metrics look good, and then once we get that system firmed up, then we go ahead and trade it in out of sample data. So like I said, what you would do is you would back test, say, 2002 to 2022, you tweak it, you adjust it, make some massage it, and then what you do is test it from 2022 to 2024 and see, what does it look like now? Is it going to make money for me? Now let's take a look at the system that I wanted to talk about here today, because right before this webinar, I was a little bit late for the webinar because I just took the trade. All right. Now don't pay attention to these numbers. We'll talk about what they mean, but essentially maybe we should just find another example first before we go to this one. So what I'm going to do is I'm going to pull up a random chart here and see if we can find the same sort of setup, but on a different chart. So here, no. No, that's not a good example. I'm looking for a good example so that you can see what one of the, oh, I just had one. There it is. Ah, cool. All right, this is a good one. In fact, this is very similar to what we're looking at right now. Okay. So this is an extremely simple system, but extremely powerful, and it's something that you can test. In the next session, we will talk about a completely different strategy for reasons that'll soon become apparent. Okay, so this right here is a channel, and these should be parallel lines. Now, I'm not sure if they're perfectly parallel, but they're close enough, right? And so what we do is we wait till we have at least 2 touches on the bottom of our channel. We have in this case 3, 1, 2, 3, and then a 4th one here, which is kind of the break. And then we have at least 2 at the top. And we have 1, 2, depending on how you count it, 3, 4, or 5 maybe. But essentially you have touches up here, touches down here. And what we're waiting for is for the market to get out of the channel. Now, we have to gauge the length of the channel from the top to the bottom. And in this case, it's about 76 pips. So what I need is 76 pips on the 1-hour Canadian dollar chart. And I need to divide that by 3, which is not going to be a whole number. 25.3. So we'll say 26 pips. So the market has to go 26 pips outside of the channel, which is going to happen right here on this candle right there. Okay? Now, once this happens, actually, let's zoom in. Let me zoom in here. Once this happens and it breaks and goes 26 pips outside the channel, which happens right here, boom, right there on that candle, I can get in the trade. Now, this one is actually very clean and very clear. I would have a stop loss right above this kangaroo tail looking thing right here. So my stop loss would be roughly right there. And then I would have my entry on this closing price. So that's going to be risking about 45 pips. Now, I don't have to get in as soon as it goes, so this system is called channel 33. The way channel 33 works is you wait for a breakout. If I can spell. You wait for a breakout where the breakout is equal to 1/3 of the distance of the channel. In this case, 26 pips. Now, oftentimes after you get the breakout, you'll have a retracement move back up towards the channel. Now, some would say that actually it broke out here, and this was the retracement move to the channel. But remember, we need it to go 1/3 of the distance of the channel. Otherwise, we don't know for sure that it's a solid breakout. Okay. So you'll notice that this is a naked system. We're not using divergence or moving averages or anything like that, stochastics or RSI or any MACD. We're not using any of that stuff. We're just using price action. And the price action is we get out of the channel by 1/3 of the channel, and then we wait for maybe a bit of a pullback, or you can get in straight away. If you get in straight away, you won't miss out on the trade, but you do run into the problem where it may retrace against you quite a bit. And sometimes it'll come all the way back up, touch the channel, and then push off. So the idea is if you get in straight away when it goes immediately 1/3 of the channel on the breakout, you want to have your stop well inside the channel so that you can withstand if there is a pullback. Now in this case, the market actually retraced quite a bit on this next candle. So you did have an opportunity to get in at 18 pips cheaper or 15, 10 pips cheaper than the 45 pips of risk. But we're just going to say we had 45 pips of risk here. We got in right on the close of that candle. And so now, remember we said, what was it, 76? Was that what it was, 76? Yeah, I think it was 76. So we said 45, so it needs to go 76 pips from here. In this case, I would actually look for a little bit of a retracement, to be fair. Because 76 is going to be down here, right there. So my target is going to be right around there, I believe. Let me just double check. No, about 5 pips higher. Right around there. Okay. So this is my target right here. So we're in the trade, the stop loss is here, and it does hit right there. Okay, so that's an example of a channel 33 trade. It didn't make the retrace move back up to the channel. The current trade that I just took immediately before, literally minutes before or 30 seconds before I launched the webinar, was this one. And I'll share with you how this one works. So the red number is my stop loss, which is right about where this line is right here at 206.22. The entry price was at 207.72. So it's down about 8 pips now. And the target is up here at 209.48. Now this one actually worked out quite nice. So let's just talk about, first let's get the channel. Okay, so the channel is, what is that, 290 pips? Is that right? 290 pips? I think it's actually 207. I thought I had 270. I think I had it as 270, but maybe I don't have parallel lines here. I'm pretty sure I had 270. Anyway, maybe it was 290. Okay, it was 290. I think it was 270. Anyway, doesn't matter. Let's see where it is from here. From right here. Okay, 290. Yeah. So a third of 290 is what? Dun, dun, dun. Math is not an exact science. 290 divided by 3. Boom, 97 pips. It has to go 97 pips outside of the channel, which it did right here. Look, it went 140. And then I waited for the pullback. Now in today's webinar, we were talking about, for our members, we were talking about this trade, and I said, when this candle was forming, this right when an hour after the markets opened this week, I said, look, this candle is going to have to close really strong and make like a big shadow, or it's going to have to march up here and then do a little dipsy whoop into this green box and give me a little bounce here, like a higher low, and then I'll get in, like a long wiki candle in this box. Or if it just does a big giant move, and it made the big giant move. I actually didn't think it would do that. I thought, and you'll see, here's the 1, 2, 3, 4, 5, 6, 7, 8. So there's your 8-hour candle right there, and then it went up and came back down, and we're basically right about where the close was on the 8-hour candle, the early 8-hour candle today, right there. So now, what I'm going to do is just hold on to this for dear life and see if it gets up to 209.48 and cashes me out, or it's going to hit my stop, and that's it. That's all the channel 33 is. You can easily test this in MetaTrader or in Forex Tester or Naked Markets and see if it works. And you may want to, you may not want to. If you don't want to do this, if you don't want to trade this, then you're basically not a breakout trader, because that's what this is. It's a simple breakout strategy like the last kiss that I wrote about in the Naked Forex book. It's very similar to that, right? It just has different rules. Our stop loss is a bit closer to the entry price than the last kiss, which is typically a bit further away. Although the last kiss will often have very small losses. You rarely would get a complete 1R loss, whereas you'll get more 1R losses with channel 33. But I find it to be quite reliable. And again, it's something that you can quite easily test. So any questions about any of this? Don't take my word for it. Test it for yourself and see if this is something that works. I would recommend Naked Markets. That's the one I would recommend. That's the best one I know of. Question maybe for Blair. Most strategies use very significant levels and look for confluence of 2 or more. I combine this with what I think are significant times. If the pound reaches a level at London open, it's much more significant than it happened in the middle of the Asian session. Yeah, time matters. So, Sean, we've talked a lot about this, like in the forum, and we have members that have posted their data as well. There's what I call the Asian drift. So if the Asian session goes one way, I expect it to possibly go the other, especially for like pound, euro, things like that. You may not see the same sort of associations when you're talking about like the yen, for example. But typically, yeah, you would expect that with so the Asian drift. Sorry, I don't want to get off track. The Asian drift is basically where we see the markets go one way during Asian session, and then they'll often, either during New York Open or London Open, sharply reverse and go the other way. It's quite common, actually. Yep. The other one to keep in mind, and actually, I'm just finishing up a book. I started reading it earlier, I think late last year, and then put it down and got some more interesting books, and now I picked it up again. But there's a book about, I don't know if you guys know who Jim Simons is, but I think it's called The Man Who Solved the Market or something like that. What? It's a pretty funny book, like the title. It's a good book. It's a good book if you like reading about quants and stuff like that. It reminds me of the book. There was a book called The Predictors, which was quite good as well. And it's kind of similar to that, I guess, in some ways. But anyway, people know Jim Simons. He's like a mathematician guy who started a hedge fund and all that. But in this book, this is the book right here. And I think it came out last year. I think it's a new one. Anyway, what's interesting is they were talking about some of their most reliable strategies that all these, math nerds came up with were things like, buy on Friday and sell on Monday. And this is exactly what we found. We as in myself and some of the students I work with, we found that typically Mondays and Fridays are sort of like the odd days out. And again, this is something that, don't take my word for it. You should go test it and see it for yourself. But what they found was that they would buy, if Fridays were up, they would buy on Fridays and they would cash out on Monday. And the reason why they would is because the reversal would come Tuesday, Wednesday, Thursday. If you've heard me talk about, in any of my webinars in the last 16 years, you know that I like to take trades on Tuesday, Wednesday, and Thursday. The reason why is because these moves on Fridays and Mondays typically go against the bulk of the move during the week. And so they found that they believed that many traders liked getting out of their trades on Friday because they didn't like holding it over the weekend, worried that some news would come out, and then on Friday they get gapped or something or on Monday when the market's open, they'd get gapped or something like that. And so that's why they decided that they would, that a lot of traders will say, you got to get out and be flat on Fridays, but they did the opposite. They were buying on Fridays and getting out on Mondays. And so that's the exact same thing that we found. If you look at daily charts here, let's just pull up like the euro, for example. Again, I'm just pulling this is just at random, guys. I'm not trying to cherry pick or anything like that. I'm just, here, let's put our period separators in here. So you can see, yep. Oh, it's going to be monthly. We'll have to go 4 hour. So we'll go 4 hour. Okay, so here's your Monday. 1, 2, 3, 4, 5, 6. So here's your Monday right here. From here, this open to this close. Here's your Tuesday, your Wednesday, your Thursday, your Friday. Friday's here. So Friday was up, Monday was up. So here, Friday is sort of flat, and Monday's up. Fridays. Actually, let's go. Let's do this. What we'll do is we'll just do the daily. So what day is this? This is the 12th, 11th, 8th. Okay. So this is a Monday, neutral day, Tuesday up, Wednesday up, Thursday up, Friday down. Friday down, Monday up, Tuesday up, Wednesday down, Thursday up, Friday basically, unchanged, neutral. Monday up, interesting. Tuesday down, Wednesday down, Thursday down. Oh no, that was the weekend, wasn't it? Okay, so that actually that's a gap because of New Year's, so that's probably not a good one to use. Let's go to another one. So what's this? This is 21, 22, 23, 20, 17. Okay, so this is the 17th? No, this is the 17th. So that's Friday. Friday up, Monday up, Tuesday up, Wednesday up, Thursday down, Friday down. Monday up, Tuesday up, Wednesday up, Thursday up, Friday down. It's pretty funny how you get these moves right at the end of the week. So you'll often see this. Let's see what this one is. 1, 2. Okay, 27th. 27th right here. So that's Friday down, Monday down, Tuesday up, Wednesday up, Thursday down, Friday way down. And then here you go, Monday way down as well. So that's the relationship. It's not perfect, but it's something that we've noticed. So when you talk about cycles or like weekly cycles and daily cycles, my ideal would be to trade on Tuesday, Wednesday, Thursdays if I'm looking for a major move. But I'll take trades on Mondays like I did today. And the other thing is that if I'm looking for like a multi-day move, I probably am not going to take it on a Friday, because typically like you'll get these really wicked looking kangaroo tails on a Friday, but they don't mean anything because it was just people closing out their positions on Friday. I put very, very little stock in what the market does on a Friday. So it's, especially if I'm trading daily candles, right? Okay. All right. What else do we have going on here? More questions. I don't worry about carry. What I do for carry is, like, if I have a system where I have a trailing exit and then a target. So a lot of my systems, not the one that we just talked about though, but a lot of my systems will have a target where you're trying to hit like 1-to-1. What I do is I push that out to 1.1 or 1.15 to 1. And the reason why is to cover if we get gaps and slippage, and also carry. So what we're trying to do is average about 1-to-1. And then the trailing exit is the one that's occasionally will catch those huge, 3+ standard deviation moves. That's the whole point of using a trailing exit. You're going to get a lot of more variability in your exits, and the standard deviation is going to widen. But what will happen is you'll catch enough of the fat tails to make it worth it. So I use both. Never trust a Monday setup. I try to keep my charts closed on Mondays in case I'm tempted. Yeah, if I'm trading this, the one that I have here, my setup here, this is so clean. I'm not gonna have a problem. If I get stopped out on this, so be it. Because this is so clean. I've been watching this for a long time. In fact, you could argue that the actual trade was actually here. This was the actual breakout, the 90 pip breakout or whatever. Where was the 90 pip breakout? It was here, actually, on this long tail right here. And then what I'm doing is I'm just banking on the pullback, and we did get the pullback. We got the pullback exactly to the trend line, and so now we're bouncing. And if we go up a little bit and then pull back later in the week, and then go up a little bit later and cash out next week, fine. That's totally cool. It's an 8-hour chart, You only get 3 of these candles a day. So I'm totally cool with that. Yep. All right, any other questions? So this is what we talked about. I just want to make sure we're covering all that we planned to. So we talked about how to trade the best strategy for you. This is a great strategy if you like trading breakouts. If you like watching the market tighten up and tighten into a range and you know it's going to break out of it, this is for you, right? You can build your confidence by taking a lot of trades. You can take expensive trades in the live markets, or you can take cheaper trades in a demo account, which is going to be pretty slow and a lot of demos will expire, or you can use a simulator. So that's how you're going to build your confidence. If you don't want to give up on your strategy, you need to align your strategy with your beliefs. And the easiest way to do that is to look at those charts like we did earlier on and say, look, what's going to happen here? Is it going to go higher, or is it going to turn around? Is it going to go lower, or is it going to turn around? And when you're looking at a range-bound market, what's going to happen here? Should I trade the edges of the range, or should I wait for the breakout? So there's different types of approaches depending on what you think makes sense to you. You can build non-core or low correlated strategies and do so by trading systems that you believe in. So actually, we should talk about this. I'll show you some examples so you guys can see, because this is important. If you haven't seen this, here's one of our members who he basically built up 3. I'll show you, because this is good stuff. Boom, Alexander. So what happens here is he was trading. These are his strategies, right? So here's his equity curve. Not so impressive, right? We're getting a little bit better. Okay. Again, not so good. So he's doing all this testing, and we're looking at different things, blah, blah, blah. This looks terrible, right? And then he flipped it which is funny. Anyway, what I want to do is keep going here because it actually gets much better. This is a great example. I posted a video for him here, but this is an example of what happens when you don't give up, right? And what you do is you trade multiple strategies. So he ended up settling on 3 different strategies. So here's some equity curves. You can see getting somewhat better, right? And then when you put the master system together, you end up with this, right? And this is all of them together. So these are all 3 strategies together where he's nailed the exit. We did a lot of work on the exits. We'll talk more about those in the next session. But this is what it looks like when you get 3 very low correlated systems and you put them together, right? So this is January 2019 to December 2022. So that's 3 years. That's 3 years. So and this is very low risk too. So pretty cool stuff when you put it all together. And again, it was a lot of this. It was a lot of this before it became this, right? And so that's what I'm trying to get across, is that once you can find just a few systems, you only need 2 or 3 systems that are low correlated. Again, we'll talk about this in the next session. But once you get that, it just really reduces your overall drawdowns. It makes it so much easier to trade long term. Okay. All right. So that's that. Do we have any other questions here? I want to make sure we cover everything we said we would. Would you recommend waiting for a pullback so you can have a smaller stop loss, or get in straight away with a bigger stop loss? Good question. So what we found, what I found in my testing, and you may find something different. Don't want to say this is definitely the law, but this is what I found, is that it depends on what you want. You can get a higher reward to risk ratio, but a lower win rate if you get in on a retracement. However, if you and so because you have a smaller stop loss, right? So it makes it a lot easier to go for the same target and have a bigger reward risk ratio. However, whenever you're getting in when the market's going against you, what's happening is the market is going the wrong way, and you're saying, I hope it turns around and goes the other way. And every single losing trade you ever take is going to first go against you before it hits your stop loss, right? So that's the disadvantage of getting in on the retracement move. So if you use like a buy stop above a bullish candle, like I did here on this one, or if you use a sell stop below a bearish candle, you're saying, hey market, I want you to go lower and prove to me that you want to go lower before I'm interested in getting short. Or likewise on a long, you say, look, hey Mr. Market, if you go higher and take out this high, then I'm interested in going long because you're proving to me that you want to go higher. So that's going to give you a much lower reward risk ratio, but it's going to bump up your win rate. So it really depends on what's important to you. Does that make sense, Sean? Hopefully that helps. Yeah. Cool. Any other questiones? No? Yes? Okay, in the next session, we're going to talk about a different trading strategy. We're also going to talk about how to determine whether or not you're going to hit your, breaking point, and how to avoid your breaking point. And so we're going to talk about a completely different strategy that's different to this one. We're going to talk about how that works, why you might trade it, why you might not want to trade it. We'll talk about the sweet area that you can, where you want to do most of your work on your trading systems. We talk about this a lot in the one-on-one coaching program. A lot of the traders get the biggest bang from their buck by tweaking their strategy in this area. I want to talk about that in our next session. So we shall see you then. Again, if you're interested in getting your trading blueprint and possibly applying for our program, you can always just click the link. I think it's in here. I'll put it in here one more time for you, okay? It's this right here. Actually, you should see it. It should have popped up for you if you want to. There. Boom. There's the link right there. And you can click that. If there are any slots available, you can book your call. Make sure that you fill out the questionnaire too, or your time will be canceled and we'll open it up for someone else.
All right. Have you found any thoughts on weekly pivots? Yeah. They can be pretty good. I like them for mean reversion. And in fact, that was one of the ones that we might talk about in the next session. Actually, it's just funny you brought that up, Sean. But yeah. So pivots can be really good for mean reversion. Yeah, absolutely. Yep. Cool. All right, guys. I appreciate your time. Thanks for spending time here. Thanks to those of you if you're watching the recording, and we'll see you in part 2. Thanks for spending time. See ya. Bye. Happy trading. See you, Brian. See you, David. Thanks, Sean. See you, Margaret. Bye.